Hi everyone, it's Jack back with another video. Today I'm going to be talking about Crowdstrike, very interesting company, endpoint security provider, so essentially a cybersecurity company that just released its earnings today. I thought they were pretty impressive, so I thought I'd better talk about it, let you know whether I think it's a buy, sell or a hold, talk about this company's report and its prospects for the future. Right now it's a $45 billion company, which in my opinion is objectively expensive at price sales of above 20, but there's a lot of room for growth here, and this could be a potentially enormous company. Long-term tailwinds for the cybersecurity industry, and this is potentially one of the winners. It's right in the middle of its 52-week performance, 52-week high of just shy of $300, 52-week low of $130. When is it $300? It looked insanely overvalued in my opinion. It had a price sales of well above 40, and it just all got a bit frothy. That's came back down to earth. But year to date, it's actually up 5%, far outperforming the S&P 500. As people struggle to sell companies that have 60% growth with excellent free cash flow margins and good gross margins. So I think that's reasonable. So let's dive in. Headline for this quarter is that revenue growth continues to be strong with 62% subscription growth year over year, which is 94% of the total revenue. Subscription revenue is now 94% of the total revenue. And this is above analyst consensus expectations. Obviously an excellent result for CrowdStrike, slightly below the total subscription growth rate for the year, which is 69%. Subscription services will slowly consume professional services and likely become the absolute majority of the business, 98-99%. I'm sure there'll still be some professional services on a legacy basis, but subscription services is where all the gross margin for this company is, and it's basically the only thing they care about when reporting, and it is the reason you would invest in this company. Slightly below where we would like. The annual revenue, 69%, 62% is not as high as that, so there's clearly been some slight deceleration, but this is still above where analysts were expecting, so strong performance continues. Bit of a high-level summary, the annual recurring revenue is now $2.14 billion, that's up 59% year over year, another excellent result for this company that just continues to keep ticking on up. 60% subscription revenue growth, as I mentioned. They also beat on earnings per share on a non-GAAP basis, operating profit of $87 million. Genuine free cash flow. It's a genuine free cash flow positive business, and that is, well, when it's growing 60%, that is nothing to be sniffed at, considering this is still a relatively young company. $136 million in free cash flow is an 84% rule of 40 company, which is obviously very impressive. 19,000, just shy of 20,000 subscription customers. That's up a decent amount, but 59% of subscription customers are now using 5 or more modules. This is a business that typically sells its platform in modules. I think the minimum you can have is 2, and it continues to increase up to as many as they offer, which is more than 10. More than 5 you pay by the module. More than 5 is a nice amount. That customer number of just shy of 20,000 represents 51% growth year over year. Last year they recorded 16,000 customers. Halfway through this year, they're already at nearly 20,000. As of July the 31st this year, they have 537 of the Global 2000, 69 of the Fortune 100, 258 of the Fortune 500, and 15 of the top US banks are subscription customers for CrowdStrike, and this is only growing. Coupled with that strong 50% customer growth, many of them being big customers, the retention rates are excellent. At the end of last year, there was some above 98%, which is absolutely fantastic, very low churn for a company like this, and just speaks to the high switching costs and how sticky a business like this is. It's once you become reliant on it, it's very hard to get rid of it, and it's such an essential service. The net dollar-based retention rate, essentially how much the current customers they have are spending extra on the platform every year. The typical benchmark is around 120%. The last 2 quarters have been above that 120% benchmark. It's typically been a lot higher, 147% in the end of 2019, came down and down and down. They've set a 120% benchmark target for themselves, which is still 20% increased spend on average for every customer. This is absolutely fine by me. I think this is a completely reasonable number, and they're succeeding this benchmark so far on a relatively consistent basis. They've had 1 quarter since the start of 2018 where they've missed this. So I'm absolutely fine with them continuing to treat this as the benchmark level, and as long as they continue performing well. The growth of CrowdStrike's annual recurring revenue is truly spectacular. So going back to 2017, so they do their reporting slightly differently. Q1 18 is in 2017. They were doing $71 million in annual recurring revenue, and in the most recent quarter, it was 2.1 billion. That is absolutely staggering growth, tremendous numbers, and speaks to the strength of this business and how quickly it is adapted. Its R&D has been absolutely exceptional. They have continued to add to the product, and have done so in a sustainable way, producing really high gross margins and just generally always hitting the target. I think this is an absolutely fantastic company from this point of view. And while the growth is slowing down because they came from once a very small base to now quite a large base in not a lot amount of time, I think if it continues to grow even above 30% revenue with a 20% net dollar expansion rate, I'm absolutely fine with that. Now it's 60% year over year growth. This is absolutely exceptional in my opinion, and I do think this is going to decelerate in the future, but that's absolutely fine by me. That's to be expected, and this is still excellent performance from an excellent business. One of the reasons this business is held at such a premium is because of its excellent gross margin. Total gross margin of 77% for the first half of this year. Truly spectacular. This is the benefits of having a really strong SaaS business. Of course, there are SaaS businesses that have slightly higher gross margins, 90+% for the likes of Adobe, but this is an absolutely fine number for me. This is obviously includes the professional services. Just subscription gross margin is 79%. They've stated that their long-term targets are between 75 and 82%, I believe, and a free cash flow margin, long-term target of 30%. If they can manage that, a 30% free cash flow margin with the size of the TAM and the revenue growth that they're experiencing, this could be a truly tremendous compounder in the future, in my opinion. And that TAM is expanding massively. That's essentially because they have not only organic total addressable market growth from the large compound annual growth rate that cybersecurity and endpoint security specifically is receiving, but the product roadmap is growing dramatically. They've consistently produced high quality research and development at this company, put a lot of revenue back into the business to produce more functionality, more product offerings, and just with the portfolio for 2024, they believe the total addressable market is 71 billion. Future initiatives and with cloud security options, they think they can get this to $126 billion potential TAM in 2025, including the planned offerings. This is absolutely staggering growth from where it was in 2019 at IPO at just 25 billion. Shows this business is incredible optionality and management's real ambition to push this business in new directions. And that is exactly what you want to see from a management of a company that is young, growing very fast. Obviously, any business that's growing revenue at 60% a year on 80% gross margins with an incredibly large TAM in an industry that's having 10% plus compound annual growth rate, it's not going to go unnoticed, and that is spoke to in its valuation. 20 plus times price sales is a little bit outdated because it's not accounted for the current release of earnings today, but let's call it 25 times sales. That is objectively expensive in today's market in a high interest rate environment, an inflationary environment. 25 times sales is very, very expensive, even for a company of this quality. You're looking at 80 to 90 times free cash flow, which is again objectively very expensive. Of course, this is cheap for Crowdstrike's historical valuations because this was once a company growing at over 100% with these same gross margins, and it's still growing very nicely. This is an objectively cheap time to pick up Crowdstrike versus its historical valuations. However, this is just not a cheap company. And if you want to own this company, you need to come with the inherent risk that this is a highly valued company that can move a lot based upon this and will be highly volatile in an inflationary, high interest rate environment. And to be honest, that is really the only negative I can pick up on. The growth is decelerating somewhat because they're coming off a very low base several years ago. And of course, as the number gets bigger, the growth is likely going to decrease because they're now at $2.1 billion annualized recurring revenue. They couldn't grow 100% every year forever. That's just unrealistic. Right now, it's a $45 billion company. Do I think it'll be significantly larger in the future? Yes, absolutely. I think this is a fantastic business with fantastic product that is growing, treating its customers very well, growing the number of customers very fast, and they're increasingly spending more on the platform and getting more product offerings to spend even more on. I think it's going to do this with really strong gross margins. I think it can achieve its 30% free cash flow margin. I think it'll be an excellent compounder in the future. I just think it's objectively very expensive right now, and I'm not really willing to dip my toe into this stock at 25 times sales in a high interest rate inflationary environment. When it was at $130, I had a really close look at it, but that was kind of in a point in the market where you would not dream of buying a company that was even then 20 times sales. if it took another dip in the near future, maybe to under 150, I'll be taking a very, very close look at this business, because I do think it has excellent potential for the future. I'm just not willing to hold another high volatility potential growthy type company when I already have a few in my portfolio. I don't really have the space or the mindset for that right now, because I think it's quite stressful owning companies like this. However, I of course think it'll be an excellent stock to hold over the longer term. So right now, I would call it a hold. I don't think it's buyable at these prices for me. Definitely not a sell, because I think it's a strong company. However, that's just my opinion. Don't take any of this financial advice, because I'm not a financial advisor. You should do your own research and due diligence. Let me know what you think down below in the comments. Like and subscribe and enjoy the videos. I'll see you next time.